All right, we got to talk markets. They've been selling off. It's been pretty nasty past week. Of course, last Wednesday, we made new all-time highs. Since then, markets, I think the S&P is down about 4.5%. So it's been a rough ride over the last 5 trading days. We're going to talk what's going on with markets, what seems to be the main driver of the sell-off, or at least what I'm seeing is being attributed as the main driver of that sell-off's hint. It looks to be the bond market, or at least what the bond market's signaling. And so because of that, we're going to talk bonds, yields, what the implication is of the bond market on the broader macroeconomy. And we're also going to talk what the Fed has been up to, pausing QT, and what the Treasury has been up to and some of the recent statements they have had in terms of the sort of duration that they want to start issuing with the new Treasuries that they will issue. Going to be a theory-rich update. So if you like what you're seeing, make sure you hit subscribe to that notification bell on so you won't miss any updates going forward. And if you do find this video particularly helpful, give it a thumbs up on the way out. All right, let's start with Treasury yields. We got the 30-year on screen right here. And as you can see, since the start of the year, it has been effectively straight down on the yield. So the bond has been rising quite a lot. And if you just step back and take the macroeconomic 101 definition of what drives yields and why investors would increase demand for bonds and therefore pushing yields down, what you'd get is an answer is something like when market participants are wary of future growth, they're going to flee to bonds, and that is when bonds push higher. Then the signal that you get from that is that when bonds push higher, thus yields pushing lower, that is some sort of signal that market participants are concerned about future growth. And so therefore, if the bond market is signaling that they are concerned about future growth, that means that assets and the growth that has been predicated to come about to support those asset prices might not end up being there. And then you end up seeing bond yields collapse, markets collapse, stocks collapse as the bonds raise higher. That is the underlying theory. Here's why I just don't buy that at this point. One, I see nothing in the data at this point that is suggesting that we're going to get some sort of slowdown into the future. If anything, I think what we're going to end up finding out is that 2025 is going to continue to kind of be a surprise to the upside sort of year. Different, as we've talked in the past about what took place in 2023 and 2024, instead of being a massive deficit surge that drives the growth, we're starting to see all the signs align that we are in the next big credit cycle, and that is going to push the growth. But at this point, I'm not seeing anything that's saying that growth isn't going to come to fruition, even with all the chaos that we've seen in terms of the various policy decisions that Trump has made and enacted. At this point, everything remains on track exactly in terms of the macroeconomic indicators, exactly as we expected. So if there is this link, and I do think there's reason to believe that part of the reason we're seeing the sell-off in stocks is because of the kind of weariness that is kind of being predicated in the market. And we're even seeing this thing, this sort of concern in indicators like the AAII sentiment indicator, which came out as the most bearish leaning this market has been, going all the way back to the absolute worst of the sell-off in 2022. So bearish sentiment is at the same levels as we were at the worst of it in 2022. And it's very clear that there is concern out there, but that concern is just not justified, especially from this idea that bond yields are pushing lower because there's some sort of concern that future growth just isn't going to materialize. The reason bond yields are pushing lower and bond prices are just pushing higher, especially at the long end of the curve, is because at about halfway through January, we just hit the debt ceiling. I think it was about January 17th. So right around this time right here, we hit the debt ceiling. What does that mean when you hit the debt ceiling? Well, the government was still going to issue the spending that they have to issue. They're still going to pay their bills, so to speak, and that spending is still going to hit the private sector. So what the private sector wants to do with that spending, and when the Treasury spends out of their TGA account, which is just their account at the Federal Reserve, they're spending out reserves into the private sector. So now the private sector has those reserves, and there is a massive demand for treasuries, particularly long-dated treasuries with those or for those reserves. In normal proceedings and normal happening, when we're not up against a debt ceiling, how the Treasury funds its TGA is it issues bonds, bills, notes, the spectrum of duration. It issues those treasuries that then absorb the reserves that are heading out into the private sector. In other words, we've just created a demand for treasuries, but a lack of supply. We've just cut off the supply of the issuance of the treasuries that would normally absorb those new issuance of reserves. So we've just essentially created a supply shock of treasuries, and that completely explains then why we're seeing treasuries take off, yields fall. And if you're not privy to this and you're just a market participant who has their simple models set up to say, look, bonds push higher, yields push lower, therefore we sell stocks, and you're kind of programmatic about it, you're going to sell stocks, even though the underlying reason has nothing to do with the future outcome of the macroeconomy and the realization of kind of the growth prospects that are being priced into stocks. No, it's just a purely mechanical reset, if you will, just because of the debt limit. So with that being said, I think, and in fact, 4 out of the last 5 times that we've seen the debt ceiling get hit and we've gotten into this situation, we've seen exactly what we're seeing right now. Bonds rally, yields fall. And it is a complete logical conclusion that this is what we would see. So here we are right now in that current scenario. The reserves are hitting and there's just nothing to mop up those reserves. So until the debt ceiling gets resolved and the spending bill gets passed, we should expect this sort of supply shock pressure to continue in the bond market. Now, there's another aspect to this current debate with regards to what is taking place with treasuries. And this is going to get a little bit deeper into theory, into understanding macroeconomic mechanisms in terms of what the Fed does and how that relates to outcomes, not only in the financial markets, but also in the broader economy. And so we found 2 things out. One, the FOMC had their minutes release last week. And what we found out from the minutes is that the Fed is going to pause QT. And they have their reasons for this. We're not going to go into necessarily their reasons, but the interpretation then of the pausing of QT. And so what the Fed says QT is they're allowing their current portfolio of bonds to roll off their balance sheet, and they're not buying them back or replacing. So in other words, when QE took place, what the Fed did is they said, okay, we think there might be a liquidity issue in the private sector banks. We're going to go ahead and take the bonds off your balance sheet. We're going to hold them on our balance sheet. You're going to get the reserves instead, and that is somehow going to magically create more lending by banks. We'll get into why that isn't the case, but suffice to say, that's the logic. And now the Fed is saying, or the Fed, when they started QT, they started unraveling that process where they were no longer repurchasing the bonds to hold their balance sheet. So they're letting their balance sheet decline. We also got the Treasury to come out and say that they intend to, when they start issuing bonds again, they intend to start going longer into duration. And the effective summary of this, or the potential impact of this, is that when you change the composition of what is being issued, that's going to change the composition of all assets that exist, and that is somehow going to potentially mess with financial markets in the valuation of financial markets. And even more potentially, or at least kind of what the Fed thinks that they're doing, that this is going to then have some longer term impact on the macroeconomic condition. And this is where, from kind of a post-Keynesian framework, we have to just step in and strongly disagree with this concept. The only part that I will agree with is that in the very short run, if the Fed messes with the composition of outstanding financial assets by either QT or QE, one way or another, or they change what it is that their guidance is, or the Treasury changes the guidance on issuance, that could have a very short-term effect on financial assets, and it could be part of the reason why we are continuing to see this selling play out. However, it is very short-lived, and any changes that end up happening in those valuations will quickly revert, because when the Fed makes any decision on composition of assets or where it's at with setting rates, that those decisions are not changing macroeconomic outcomes, and we'll explain why in just a second. They are just picking new winners and losers, and usually the losers get figured out first, and then it takes a little while for the winners to eventually find their way to the top, or the new winners find their way to the top, thus leveling whatever impact in the long run that happened immediately when those changes in policy took place. To kind of visualize this in terms of composition of assets, I found a little chart on Google that just kind of shows this idea that when you're thinking about, or when the vast majority of kind of money managers think about, okay, how am I going to build a portfolio of various assets? They want to build a diversified portfolio of kind of all assets that are out there that go from the spectrum of least risky, so in this case on the chart right here, cash or short-term bonds, up the risk curve to more risky, right? So in this kind of example here, we have cash, which would be the least risky, but it's also returning the least. Obviously, cash has no return whatsoever. And in an inflationary environment, you're actually getting punished to hold cash. Short-term bonds then have the slightly more return, or at least expected return. And then as you go up the risk curve, then you get into long-term bonds, and then you get into equities, corporate bonds, and then maybe even things like bank loans. And so as you push up this risk curve, you also expect more returns along the way. And without a doubt, if you change the composition, and the Fed can change the composition insofar as it can change effectively how many reserves or cash are in the system, to how many short-term, long-term dated bonds, and even in major crises, they can even buy things like mortgage-backed securities. They can change the composition, but the fundamental, and this is the main point of this video, the fundamental flaw in the logic, or the fundamental misstep, is that future economic growth is in any way predicated upon the composition of the financial assets saving in the private sector in the first place. This is a classic kind of fallacy that particularly the loanable funds crowd falls into, that it's the type of money or amount of money or this pool of money or the stock of money that exists in the private sector that then drives future investment, drives loan creation, where the loans are, funded via this outstanding pool of money. That is not how it works. The key insight that the post-Keynesian approach has is that loans create the deposits endogenously. Money is always created endogenously, and the primary driver of a loan is there a profit to be made if I make this loan? So from the borrower standpoint, can I make a profit if I decide to take out this loan to build some factory, to make some widgets, or to buy a server, to stand up some new website or something like that, right? Can I make a profit? So it is the profit expectation that is the main driver of growth, because the money supply is not the composition of these assets and the total amount of these assets. It's what profit expectation is there that I can make and then pay back the loan and then make some profit on top of that. That is the driver of growth, and it's the investment then that drives the total amount of financial assets and real assets in the broader case that end up in the private sector. So when the Fed comes in and they say, hey, we're just going to change the composition of assets, in the grand scheme of things, that might change the valuation of some companies. I won't negate that reality, but the valuation of these companies has nothing to do with the future potential of profits. What does have something to do with the future potential of profits is what is the flow, or where is the flow of those profits coming from? In other words, where is the flow of these financial assets coming from? And what the Levy-Kleski equation tells us, and again, this is post-Keynesian gold, if you will, is it tells us that the source of the flow of profits that will then fund or make possible the demand, drive the demand for new loans to create new output, is government spending. It's the supply of these assets in the first place, hitting these financial assets, hitting the private sector, which then drives higher profit expectations and then ultimately drives economic growth. So when the Fed when the Fed messes with the interest rate or they mess with the composition of assets, you might get some companies that are going to do worse than other companies in a high or low rate environment, or in an environment where riskier assets are more abundant versus non-risky assets. You might get winners and losers, and eventually or immediately you'll probably figure out who the losers are. And as of right now, it's been the biggest names in terms of the recent news that we've seen with the Fed. They've been hit hard, but there is a new winner that has yet to been fully realized because we haven't seen the flow of profit hit their balance sheet. But that new winner will come around and will offset in the long run. And by long run, I'm not saying months, I'm not saying like years down the road. I'm saying months down the road, we're going to know who the new winners are. The market will figure that out, and we will get back to the trajectory that we were off on in the first place. So I am, suffice to say, I am not convinced that anything the Fed is doing right now or anything the Treasury is doing right now is going to have any material impact on the long-term trajectory of the business cycle. What could have a long-term impact on the trajectory of the business cycle is what spending, tax cuts might play out. That remains to be seen. And I'm certainly not all that concerned about what the Fed or Treasury is doing in terms of the issuance or composition of the financial assets that exist in the private sector right now. So all that being said, it is, again, the most important thing is what is the profit expectation of the private sector, because that creates the creditworthiness of the borrower if the bank thinks those profits can be fully realized. And if the borrower thinks they can get those profits, they're going to make the loan to create the new output to drive after those profits. That is the real driver. That is the key insight. And as it stands right now, the primary flow of those profits into the private sector, government spending, as of right now, hasn't been all that derailed despite all the shenanigans that we're seeing in Washington. So as it stands, I think at the end of the day, as we head into the summertime, assuming nothing crazy happens out of Washington, which could happen, as of right now, everything remains in place, that I do think we're going to get that big credit expansion into the end of this year, which is only going to drive future growth, drive future expectations, and ultimately drive financial markets and equity markets higher. So that is where we are at right now. If you're an active trader, active investor, make sure you head on over to appliedmmt.com. Get signed up for updates just like this in a lot more detail. We have plenty of models and tools that show all the sort of actionable information that you want if you are an active trader, active investor. Again, appliedmmt.com. Other than that, as always, good trading, everyone, and we will talk to you next time. Bye-bye.